Having a good investment strategy can be the difference between rags and riches, living in a simple house or a giant castle, going on a camping trip in a tent for your vacation, or exploring the world on an airplane. So is investing in a bear market totally insane and a great way to lose all your money, or is it completely brilliant and your ticket to wealth? Whether you're investing in stocks or bonds or magic cards or real estate, or hopefully a combination of all of the above, the goal is simple. You put money aside now in hopes that it will grow in the future and give you more buying power later in life. Cool, sounds simple enough, but what if I buy an asset and then it just plummets in value? That sucks! Well, the solution is simple. Just buy the dip. Buy low and sell high. It's not complicated. The problem with this solution is that unless you have magical powers and can predict the future, we only know the highs and lows in hindsight after it's too late. When you're investing during a recession or in a bear market, you are buying in a dip, but you must recognize that there's a really good chance that a lot of the assets you're buying are going to continue to go down in price. You are buying during an overall dip and economic downturn, but most likely you're not buying at the exact lowest of lows. So why do this at all? Why torture yourself and buy assets that are almost certainly going to go down in value? Because in the long term, you're so likely to win. If you're buying good, solid assets, you don't care if the price goes up or down tomorrow or next week or next month or next year. What really matters is what is this asset going to do over 10, 15, 20 years? You got to keep a long-term perspective. Timing the market to maximize your returns is simply impossible. When someone tells you that they're really good at day trading and they can time the market, they're lying. Yeah, you gotta buy on a Tuesday and make sure you sell on a Wednesday afternoon, but only if there was a full moon on the previous Sunday. Good luck. Nobody can time the market, but long-term investing during a bear market is different. Your goal is to buy good assets and hold them. You just happen to be getting better prices on those assets than if you were to buy them during a bull market, thus improving your long-term rate of return. Remember that investment returns are not steady. We talk about average rates of return, but averages can be misleading. You can have one hand in ice water and the other hand on the stove, and the average temperature of your hands is pretty decent, but you are not enjoying this experience. So just because an asset has a good year-over-year average rate of return doesn't necessarily mean that it was smooth sailing. In many cases, a large percentage of your return was made during a disproportionately small amount of time. Let's look at Double Master VIP packs over the last 15 months as our example. You can see that they go from about 120 to around 200 in 15 months, which is about a 66% return. That is phenomenal for such a short period of time. Now, if this is smooth and steady, that should be about 4 to 5% a month. Is that what you see? I don't think so. You can see it starts around 120 and sits around for a few months, eventually drifting up to about 130, and then all of a sudden, boom! In 1 month, you can see that it jumps up from $130 all the way to $200. That's a huge jump. It pops up about $60 to $70, around a 50% return in just 1 month. And then it levels out for a while and kind of stays flat and doesn't really do anything for a good 3 months, just hovering around $180. And bam! It jumps up in just about a month to $200. That's another $20 to $30, about 10% jump up in just a month. So even though this might look like it has great returns over a long period of time, and it does, they were not smooth and steady at all. Most of the returns were made during a very small percentage of the time. The stock market is the same way. Look at the S&P 500 over the last 5 years. Does that look smooth to you? It jumps up and down all over the place. Recessions are not fun, and they can be stressful. Investing is always risky, but especially during times of economic hardships. However, with greater risk does come greater upside potential. Maybe the world does end tomorrow, but more likely the world will keep spinning, and in 5 to 10 years there's a good chance that we look back and think that today's prices on assets were incredibly cheap. Will you look back and regret not taking action, or will you be seeing great returns in your portfolio? Be sure to obliterate the like button, and if you haven't joined the Wolf Pack already, do so right now by hitting subscribe. And lastly, if you found value in this video, feel free to share it with a friend. I appreciate it. It really helps the channel grow.